Welcome to today's market report.
European shares posted their worst day in 2 weeks on Tuesday as rising bond yields, worries about the war in Ukraine, and a batch of upcoming earnings kept investors on edge, while energy shares outperformed despite plunging oil prices. The Pan-European Stock 600 lost 0.8%, with defensive stocks including healthcare and consumer staples leading declines. All major regional equity markets were in the red. The index, however, ended well off session lows as energy shares rose 0.5% despite a 5% slump in crude prices, and as Wall Street opened strongly on an earnings boost. Bond yields in Europe and the US surged on Tuesday on expectations for tighter monetary policies. Total Energies, BP, and Shell were the biggest boosts to the Stock 600, up between 0.4% and 1.6%. Energy is considered to be value, so when you get a material jump in bond yields, as we are seeing today, you tend to get to see energy outperforming because it is still trading relatively cheap to other sectors, such as consumer, discretionary, and several others. The International Monetary Fund and the World Bank slashed their forecast for global economic growth by nearly a full percent point as Russia presses ahead with its war in Ukraine. Any suggestion that Ukraine tensions are going to be prolonged or more violent is enough to mute sentiment in markets. France's CAC 40 fell 0.8%. President Emmanuel Macron's lead in voting intention polls for the second round election runoff on 24th of April widened further on Tuesday. While the earnings season for companies in Europe has so far been mixed, focus will be on firms reporting this week such as Eka and L'Oreal. First quarter earnings for companies on the Stock 600 are expected to rise 24.7% from a year ago, according to Refinitiv. GBP/USD flirted with the 130 level on Tuesday, with the bears eyeing but not quite getting a test of last week's multi-month lows in the 129.70 area. The US dollar rose this week to a fresh 20-year high, whilst the euro-dollar kept low at 107.61.
This is today's market news. Thanks for listening. We'll see you next time.